Money is weird. Let's start there. You wake up, check your phone, see the same bank balance you saw yesterday, and somehow it feels smaller. Nothing changed. No bills posted, no purchases, no mysterious subscription to premium Viking meditation app, and yet your money feels like it lost weight overnight. That feeling isn't paranoia. That's the system working exactly as designed. Here's a question most people never ask out loud. If money is just money, why does it behave like it has a personality? Why does $1 feel powerful in one country, fragile in another, and straight up embarrassing somewhere else? Why does the same green piece of paper buy you a coffee in New York, half a sandwich in Zurich, and an entire street feast in Vietnam? And more importantly, why does nobody explain this in a way that actually makes sense? Because once you really understand money, you stop being easy to control with it. That's uncomfortable. So let's do something dangerous today. Let's actually understand what's going on. Not the boring textbook version, not the trust the experts version, the real version. The version that makes you rethink how you earn, save, spend, invest, and maybe, just maybe, stop blaming yourself for a game that was never meant to be fair. And yes, we'll make jokes along the way. Because if you can't laugh at money, money will definitely laugh at you. Imagine a guy named Bob. Bob is painfully average. That's not an insult. That's a demographic. Bob lives in the United States. He earns dollars. He spends dollars. He complains about gas prices like it's his civic duty. One day, Bob decides to travel. First stop, Germany. Bob walks into a currency exchange, hands over $1, and gets back less than €1. Bob frowns. Then Bob goes to Vietnam. Same dollar. Suddenly, he's holding tens of thousands of Vietnamese dong. Bob panics. Bob thinks he's rich. Bob is not rich. Bob is experiencing something most people never fully process. Money doesn't have value. It has belief. And belief is unstable. For most of human history, money wasn't about belief. It was about stuff. Real stuff. Heavy stuff. Shiny stuff. Stuff you could drop on your foot and immediately regret your life choices. Gold, silver, precious metals. This was the gold standard. Literally. Under the gold standard, a country's money was tied to a specific amount of gold. You couldn't just print money because you felt like it. If you wanted more money, you needed more gold. Simple, annoying, inconvenient, responsible. Which is exactly why governments eventually hated it. As economies grew, trade expanded, wars got expensive, and politicians realized that gold had a very annoying limitation. You can't print it during an emergency meeting. So slowly, quietly, countries moved away from gold. By the 1970s, the system officially changed. Money was no longer backed by gold. It was backed by something far more abstract. Trust. This is called fiat currency. Fiat money has value because the government says it does, and because everyone else agrees not to laugh when they hear that. There is no gold vault for your dollar anymore. No hidden treasure chest, no Scrooge McDuck swimming pool, just belief. And belief is influenced by fear, confidence, politics, economics, and vibes. Lots of vibes. Here's the part that makes people uncomfortable. Money today is not a store of value. It's a vote of confidence. If people believe a country is stable, productive, innovative, and capable of paying its debts, they want its currency. Demand goes up. Value goes up. If people believe a country is unstable, corrupt, reckless, or addicted to the money printer like, that's why the US dollar is strong. Not because it's perfect, but because, compared to alternatives, it's the least scary option in the room. This is also why inflation matters so much. Inflation is what happens when money loses its ability to represent real value. Too many dollars chasing too few goods. Prices rise, purchasing power falls, and suddenly, $10 doesn't feel like $10 anymore. 2 years ago, $10 bought you 2 loaves of bread. Now it buys you 1 loaf and a deep sense of betrayal. When inflation rises, people don't want to hold that currency. Why would they? Holding inflationary money is like holding ice on a hot day. You can watch it disappear in real time. So they spend it, or invest it, or exchange it for something safer. That reduces demand for the currency and weakens it further. This is how currencies spiral. If you want a real-world example, look at Zimbabwe. In the 1980s, the Zimbabwean dollar was stronger than the US dollar. Yes, really. One Zimbabwean dollar was worth more than one US dollar. Then came a perfect storm: poor economic policies, land reform disasters, corruption, sanctions, and aggressive money printing that made a laser printer look modest. The result? Hyperinflation so extreme that prices doubled in hours. People needed wheelbarrows of cash to buy groceries. The currency became so worthless that the country eventually abandoned it. Zimbabweans didn't stop using money. They stopped trusting their own. They switched to foreign currencies like the US dollar. Not because they loved America, but because they loved stability. That's lesson number 1. Money flows toward confidence, not patriotism. Now let's talk about something that quietly controls global money flows while pretending to be boring. Interest rates. Interest rates are the price of money. When a central bank raises interest rates, it's saying money is expensive now. When it lowers them, it's saying money is cheap. Please use responsibly. Or don't. Higher interest rates attract investors. Why? Because investors love yield. If US bonds pay more than German bonds, money moves to the US. To invest, investors must buy dollars. Demand for dollars rises. The dollar strengthens. Lower interest rates do the opposite. This is why entire financial markets freeze when the Federal Reserve clears its throat. One sentence from the Fed chair can move trillions of dollars faster than any politician ever could. But here's the catch. High interest rates hurt normal people. They make mortgages expensive, business loans harder to get, credit card debt painful, economic growth slows, sometimes enough to cause recessions. So central banks walk a tightrope. Too low, inflation explodes. Too high, the economy chokes. Now add foreign investment into the mix. When companies invest in a country, they need local currency. They buy land, pay workers, build factories. This creates demand for that currency and strengthens it. This is why political and economic stability matters so much. Investors don't just chase profits, they chase predictability. A country with stable laws, functioning institutions, and boring politics is extremely attractive to money. A country with protests, sudden rule changes, and unpredictable leadership, not so much. Money hates surprises. This is also why exports matter. When a country exports goods, other countries must buy its currency to pay for those goods. More exports mean more demand for the currency. The US took this idea and turned it into a global strategy with oil. For decades, oil has been priced in US dollars. If you want oil, you need dollars. Every country needs oil. Therefore, every country needs dollars. This is called the petrodollar system, and it quietly helped cement the dollar as the world's reserve currency. Reserve currency status is like being the default character in a video game. Everyone starts with you, even if they complain about your stats. Small countries don't have that luxury. Many of them peg their currency to stronger ones. Belize pegs its dollar to the US dollar. Brunei pegs to Singapore's currency. This provides stability, but at a cost. Dependence. If the anchor currency sinks, you sink with it. So why doesn't the world just use one currency? Because one-size-fits-all monetary policy is a terrible idea. Different countries have different needs. Export-heavy economies may want weaker currencies. Import-heavy economies may want stronger ones. Sharing a currency means sharing decisions. And when one country messes up, everyone pays. Just ask Europe. And this brings us to the uncomfortable truth most people avoid. Money is not neutral. Money is power. And understanding it changes how you play the game. Most people are taught to work harder, save more, budget better. And while those things matter, they don't explain why the rules keep shifting. The real advantage comes from understanding how money moves, why currencies rise and fall, and how belief, not metal, now runs the world. And once you see that, you stop asking, why am I bad with money? And start asking, what game am I actually playing? Because it's not the one they taught you in school. Let's talk about the biggest lie Americans were ever sold about money. The lie sounds responsible, mature, almost patriotic. If you work hard, save consistently, and don't do anything stupid, you'll be fine. That sentence has ruined more financial lives than bad crypto advice on Twitter. Not because hard work is bad, not because saving is useless, but because that advice ignores one brutal truth. The system doesn't reward effort, it rewards positioning. If money only cared about effort, teachers would be rich, hedge fund interns would be humble, and no one would be selling courses on how to escape the rat race from a rented Lamborghini. But here we are. Most people think money is something you earn. In reality, money is something that moves. And if you're not learning how it moves, you're standing still while everything else runs past you. This is where investment thinking begins. Not stocks, not crypto, not real estate. Thinking. Let's look at the middle class in the United States, the most stressed, overworked, underappreciated group in modern history. The people doing everything right and still feeling behind. They earn in dollars, they save in dollars, they retire in dollars, and they assume the dollar will behave. That assumption is expensive. Inflation doesn't steal loudly. It steals politely, slowly, like a friend who forgets to Venmo you back every single time for 10 years. A few % a year doesn't sound scary, until you realize it cuts your purchasing power in half over a working lifetime. And here's the part nobody likes to hear. Cash is not safety. Cash is delayed risk. When interest rates are low and inflation is high, holding cash guarantees loss. Not on paper, in reality. So why do people do it? Because cash feels simple. Because cash feels stable. Because cash doesn't fluctuate on a screen and trigger emotional meltdowns at 2 a.m. The system relies on that comfort. Smart money doesn't avoid risk. Smart money manages exposure. This is why wealthy individuals and institutions diversify across assets, currencies, geographies, and time horizons. They don't bet on one outcome, they prepare for multiple. Let's talk about the dollar again. The US dollar is the world's reserve currency. That's a massive advantage. It allows the United States to borrow cheaply, run deficits longer than other countries, and export inflation when things get uncomfortable. But reserve currency status is not permanent. It's earned daily. It depends on trust, in institutions, in rule of law, in economic productivity, in the idea that tomorrow will look roughly like today. When that trust weakens, capital doesn't protest, it relocates, quietly. This is why smart investors pay attention to macroeconomics, even if they pretend not to. Interest rate cycles, debt levels, demographics, productivity, geopolitical stability. This isn't conspiracy, it's context, and context changes everything. Let's talk about debt. Debt is another word people misunderstand. Most people think debt is bad, period. That's like saying fire is bad. Fire cooks food. Fire also burns houses down. Context matters. The US government runs on debt. Corporations use debt strategically. Wealthy individuals use debt to control assets they couldn't otherwise access. The difference between productive debt and destructive debt isn't the interest rate. It's what the debt buys you. Debt that creates future cash flow can be a tool. Debt that funds consumption is a trap. This is why the system encourages consumption so aggressively. Buy now, pay later. Upgrade constantly. Reward yourself. You deserve it. Funny on TV. Expensive in real life. Now let's talk about investing myths. Myth number 1. Investing is risky. Wrong. Not investing is risky. Inflation guarantees loss. Markets at least offer participation in growth. The real risk is ignorance. Myth number 2. You need to be rich to invest. No, you need to start. Time is the most undervalued asset in finance. Compounding doesn't care about your feelings. It rewards patience brutally. Myth number 3. The market is rigged. Also true and irrelevant. The system has always favored those who understand it. Complaining doesn't change that. Learning does. This brings us to a psychological problem most people don't realize they have. Short-term thinking. Humans evolved to survive immediate threats, not 30-year retirement timelines. Your brain is excellent at avoiding tigers. It's terrible at understanding compound interest. This is why people panic during market crashes and celebrate during bubbles. Smart money does the opposite. It buys when fear is high. It sells when optimism becomes delusional. And yes, this feels uncomfortable. If investing felt comfortable, everyone would do it well. Now let's connect this back to currencies. Currencies reflect the health, discipline, and credibility of a country's economic system. When you invest internationally, you're not just buying assets. You're making a statement about belief. Belief in growth. Belief in governance. Belief in stability. This is why global diversification matters. Putting everything in one currency, one market, one country is confidence bordering on arrogance. History punishes that. Empires rise and fall. Reserve currencies rotate. Financial centers shift. Rome didn't think it would lose relevance either. The point isn't fear. The point is humility. Now let's talk about something Americans are particularly bad at. Financial self-image. Most people don't want to be rich. They want to look successful. Big difference. Looking successful is expensive. Being financially secure is often boring. The system sells status. Smart investors buy optionality. Optionality is the ability to say no, to walk away, to wait. Money isn't about buying things. It's about buying time and freedom. And here's where mindset changes everything. Once you stop seeing money as a scorecard and start seeing it as a tool, your behavior shifts. You become less emotional, more patient, more strategic. You stop reacting to headlines and start watching patterns. You stop chasing trends and start building systems. This is where most people fail. They want certainty. Markets offer probability. They want guarantees. Money offers trade-offs. They want simple answers. Finance is contextual. But here's the good news. You don't need to be a genius to win this game. You need discipline, curiosity, and a willingness to be uncomfortable. And yes, sometimes you need to laugh at the absurdity of it all. Because if you don't, the system will happily do it for you. In the next part, we're going to go deeper. We'll talk about how smart Americans actually think about wealth. Why the safe path is often the most dangerous. How media narratives manipulate financial behavior. And how to build a money philosophy that survives chaos. This is where everything connects. Let's zoom out, way out. Because if you look at money too closely, you start arguing about pennies while missing the entire machine. The real question isn't how to make more money. The real question is, why does money seem to control people who technically have plenty of it? You've seen it. High-income professionals living paycheck to paycheck. Successful entrepreneurs who can't sleep. Retirees terrified of running out of money despite decades of saving. This isn't a math problem. It's a psychology problem. Money doesn't just live in bank accounts. It lives in expectations, fears, habits, and stories we tell ourselves. And the most dangerous stories are the ones that sound responsible. Story number 1. I'll start later. Later is the most expensive word in finance. Later means compounding works against you. Later means habits get harder to change. Later means comfort solidifies into routine. Markets don't reward intentions. They reward action sustained over time. Story number 2. I'm not a money person. That's like saying, I'm not a gravity person. You don't get to opt out. Money affects where you live, how you work, who you depend on, and what choices you can afford to make when life punches you in the face. Ignoring it doesn't make you pure. It makes you vulnerable. Story number 3. The system is broken, so why bother? Yes, the system is flawed. Yes, incentives are distorted. Yes, inequality is real. And yet, the system still allocates resources to those who understand how it functions. Refusing to learn doesn't make the system fairer. It just guarantees you won't benefit from it. Now let's talk about something uncomfortable but necessary. Responsibility without blame. You didn't design the monetary system. You didn't choose fiat currency. You didn't vote on interest rate policy, but you do choose how you respond. You choose whether you stay curious or cynical. You choose whether you react emotionally or think strategically. You choose whether you outsource your thinking or build your own framework. That's the real divide. Not rich versus poor. Not left versus right. Not Wall Street versus Main Street. It's passive versus intentional. Intentional people don't need certainty. They need clarity. Clarity about goals. Clarity about risk. Clarity about trade-offs. They understand that every financial decision is a bet on the future. Saving is a bet that stability matters more than growth. Investing is a bet that growth will continue despite chaos. Spending is a bet that present enjoyment outweighs future optionality. None of these are wrong. But unconscious bets are dangerous. Now let's talk about media. Financial media doesn't exist to educate you. It exists to hold your attention. Fear sells. Urgency sells. Outrage sells. Long-term thinking does not. So headlines scream. Charts flash red. Experts argue confidently, then disappear when they're wrong. This creates a culture of reaction. Buy now, sell now, panic now, celebrate now. Smart money moves quietly while everyone else is distracted. It doesn't chase narratives. It watches incentives, and incentives explain more than opinions ever will. Why does the system push consumption? Because consumption fuels growth. Why does it discourage patience? Because patience reduces turnover. Why does it glorify risk-taking when it works and shame it when it fails? Because outcomes matter more than process in headlines. Understanding this doesn't make you immune, but it makes you less manipulable. Now let's bring this home. What does all of this mean for a normal person living in the United States? It means your financial life is not about finding the perfect investment. It's about building a philosophy that survives volatility. A philosophy that answers questions like, how much risk am I actually comfortable with? What does enough look like for me? How do I protect myself from inflation without gambling my future? How do I balance enjoyment today with freedom tomorrow? There is no universal answer. Anyone selling certainty is selling fiction. But there are principles that work across time and systems. Diversification beats conviction. Time beats timing. Behavior beats intelligence. And humility beats confidence. The goal isn't to beat the market. It's to avoid being beaten by your own decisions. And here's the part that nobody tells you. Most financial success comes from not doing stupid things consistently, not panicking, not chasing hype, not over-leveraging, not letting ego drive decisions. It's boring, which is why it works. The sweet spot is awareness with humor. Take money seriously. Don't take yourself too seriously. Laugh at the absurdity of a system where imaginary numbers on screens dictate real human lives. Then learn it anyway, because understanding money doesn't make you greedy. It makes you less afraid. Fear is the real currency of control. When you're afraid, you accept bad deals. When you're afraid, you follow crowds. When you're afraid, you trade long-term freedom for short-term relief. Clarity breaks that cycle. This channel exists for one reason. Not to promise riches, not to sell shortcuts, not to pretend we've cracked some secret code, but to treat our audience like adults. Adults who can handle nuance. Adults who appreciate honesty. Adults who enjoy a smart joke while thinking deeply about serious things. If this video made you uncomfortable in a productive way, that's intentional. Growth rarely feels like motivation. It feels like friction. So here's the ask. Not a demand, not a trick, a choice. If this video helped you see money differently, even slightly, if it made you question assumptions you've carried for years, if it gave you language for thoughts you already had but couldn't articulate, then subscribe. Not because it helps the algorithm, but because it helps build a space where intelligent conversations about money can exist without nonsense. Hit like if you want this kind of content to survive. Algorithms don't understand quality. They understand signals. And if there's one person in your life who you argue about money with, worry about, or wish would think differently, send them this video. Not to prove a point, but to start a conversation. Finally, leave a comment. Not great video. Not a fire emoji. Write one real thought, one question, one disagreement. Because this content was built with care, research, and respect for your intelligence. And thoughtful feedback is the only real payment that matters. Money is a tool. Understanding it is a skill. Using it wisely is a lifelong practice. Thanks for thinking with us. We'll see you in the next one.